Hi, I'm Keith McCullough, and welcome to another Real Conversation. We have a really good timing on this. Craig and I dialed it up just to get the volatility moving just for the show. We have a quad shift going on from quad 4 to quad 3. Those of you that follow us know that was in motion. That is highly impacted, of course, by the Federal Reserve devaluing the dollar. So the dollar goes down and you get a bunch of correlation moves that start to go the other way, equities, et cetera. So really good time to talk about the market structure, the flows. We'll get into the fundamentals too. I don't think at this point in your career you can ignore the relationship of the flows to the fundamentals, and you can ignore them at your own risk, of course. But if you want to get into this in more detail, we brought the right team and the right guys. And Craig, I guess it's best to start with you. You have some prepared content or slides to help teach people through the process. I mean, I think that I personally, over the years, have struggled with that from time to time. It can be frustrating because you build such a sophisticated and accurate process, but not everybody knows how to use it. So it's not just my struggle; it's anyone's struggle when you create something that didn't exist. So with that, I'll let you teach in, I guess.
Yeah, absolutely. First, thanks for having us in today. Good to see you. Always fun to stop by the office. So we've had a lot of this feedback of people just not being able to understand how all of our models are working together, and that's because there's a lot going on. But I kind of want to take a step back and talk about what we're really focused on, and that's market structure. So we have this reputation around the office everywhere as being the option guys. And I think that's true in a lot of ways, but overall, why we care about the options market is because of its effect on volatility and how that affects the broader market. So when we talk about market structure, what we really mean is the options market, passive funds and passive flows, and also a much smaller but really important subset of the market, which is the systematic strategies. And as you know, we break these down into vol control funds, CTA funds, the trend followers, and also risk parity funds. And really what we're trying to capture is how these three major subsets of the market are working together and then driving broader trends in the S&P 500. So what I think a lot of people miss is just how massive this space is. So when you combine the options market with passive funds and with these systematic strategies, we're talking about $20 trillion of market. I mean, that's about 50% of the investable market that has essentially zero input for any sort of fundamentals, emotions, macro. These strategies just don't care about the Fed's rate or cutting rates or anything else. They purely work off systematic rules. And I think that's the biggest thing that I hope everybody walks away with today, is the fact that 50% of the market is operating on rules that have nothing to do with fundamentals. And
some people will give me direct feedback. Institutional investors will say, I hear you, but this is what I do. It's like, no, did you hear what we just said? $20 trillion of flow.
Massive.
It's like somebody goes up to Niagara Falls and he says, I see that, but I'm not much of a swimmer. I mean, it doesn't, I still don't know how one would approach or even try to play the game in this day and age without getting into this. So maybe take us through, because this isn't day trading, right? There are a lot of day trades, by the way, that Dave and I make, and we're degenerates to some extent, I think. You can make a lot of day trades, but that doesn't mean that this is day trading. You're just executing during the day. It's called trading.
Sure.
But I wouldn't. Some people do confuse what you and I do as being super short term and only about what's going to happen to 0 days to expiration options today, which is entirely missing the point.
Yeah, I think it does miss a lot of the really good use cases for this. So when we talk about market structure, everybody does want to day trade this stuff because they look at the gamma, they look at these intraday moves. Yeah. But ultimately what we really care about is how that volatility is going to affect all these other systematic strategies out there, and how that drives these broader trends. So I think actually if Eric wants to bring up, I think it's slide 3, we have a page of common misconceptions about market structure. And I think this is, it might be the one behind that. Well, it talks about, maybe one more down, sorry about that. But anyway, we'll figure this out. Ultimately, here we go, it's perfect. So I think the biggest misconception about market structure is that everybody wants to day trade it. And we actually think the best window to take advantage of these flows is between a 4 to 6 week period all the way out to 6 months and a year. because again, what we're really trying to do is capture these broader trends in the market that are driven by just computer algorithms, right? I mean, that's the thing, is these are non-discretionary flows. This isn't somebody sitting there making a decision and then putting in their Bloomberg and making that trade. These are just computer algorithms trading with other computer algorithms, and the biggest link between it all is really just volatility.
Well, I mean, 4 to 6 weeks, and then what I call the trend, like beyond 3 months, or getting into kind of quarterly analysis. I think that's why, and in fact, I know that's why it works, because the fundamentalists do that, right? That's what they do. This is what GDP is going to be, this is what inflation is going to be, this is what my company model is saying, but that's a quarterly exercise. Inside of that, you have this immediate term trade duration. So I live in the 3 weeks or less, but whether it's 3 weeks or 6 weeks, we really have no business saying what it is. And, as Mandelbrot would say, it's the particular that matters. It's that thing that happened while this was already happening. And to me, that's when I look at the Tier 1 alpha data and how it's augmented my process. I know exactly what I'm looking at now every single day within the context of my process. Like when, for example, guys, if you can show 1 month versus 3 month realized vol, I mean, it's not magic. The Fed happened, so people will try to tie their narrative to that, but that was happening.
Right.
The blue line was going down below the red line, and that's new. And that, again, triggers, to your point, the flows and the rules. Volatility control funds have to do something different when that blue line goes below the red line. So I think it's it's not only a misconception, but like of short term, but there's a lot of probably misconceptions in how do I use the bloody tools, right?
And there's a sense of fractal to it too, because a lot of times, over a longer duration, these vol control systematics, etc., can be adding exposure back, but we still go into negative gamma periods of time. So we might have a small period of high volatility within the context of a much broadening adding back of exposure, and we've tried to develop longer term models to represent that longer term trend, and obviously until a point. And those things matter too, because not all gamma flips are born equal. Some of them are temporary, some of them are short term. It might just be a pullback within the context of a much longer, broader positive trend. So we're trying to bring that to market and focus on that a lot more too. And I'll let Craig expand on it, but we've developed a regime model, and some of those regimes can stay positive for a year. And even though we can have deteriorating data or improving data within the context of that, the model doesn't necessarily change until the whole structure changes.
Yeah, it could change slowly, or it can change all at once. We have no business telling the damn thing what to do just because we would like the answer to be easier, right, Mike?
No, I think that's absolutely correct. And I guess what I would highlight is they talk about the regime shift, or this idea of, should we have a signal that goes on for a period of time? Easiest way to think about that is it a safe place for swimming, or is it not a safe place for swimming, right? And generally, swimming can be thought of as short volatility. Short volatility means I buy something. Short volatility means I invest my funds and I actually deploy them, right? All of those play through for extended periods of time, right? So the idea that you can remain bearish the entire time, or that you can remain day trading or scalping options all the time, those just aren't true facts, right? Every once in a while, particularly when you see an environment coming in which you're seeing a ton of positioning roll off, et cetera, those are going to cause changes in positioning. That changes in positioning or flows, and that can cause a lot of volatility, which is part of the reason why when we see things like we're seeing today, this was pretty straightforward that you were likely to see small caps rally on an aggressive Fed. Right. Could you know that the Fed was going to be aggressive going into the event? You could have a hint, but there was no true evidence that they were going to do this, right? But once they had actually done it, there were two separate things you had to deal with. We wrote about this yesterday, right? The equity markets themselves were remarkably hedged, right? You were running a single-day VIX well over 25 into the print,
Exactly.
right? And it didn't deteriorate until basically the data came out. You had a bunch of volatility around it, and you ended basically unchanged.
And that's happened quite a bit around these events. Guys, if you can show yesterday's versus today's Tier 1 Alpha short-dated calendar vol chart that I always go through on the macro show, I mean, you go from day to day, it was the setup. It's always the setup. Yep. I mean, you go to the beginning of the week, this short-term volatility was at 13. To Mike's point, yesterday it went roof to 25 into the event. It's very typical for the entirety of Wall Street to have to set up the day before or the day into CPI, NVIDIA earnings, Fed cut. And they were, what do you guys always say about a boiled pot?
A hedge pot rarely boils.
A hedge pot rarely boils, exactly. So that gets unwound. and then we
then you see the move afterwards. Right?
Yeah, it's an incredible thing to watch. I mean, it's just, what do you guys have longer term thought? I know you do, you definitely have longer term thoughts on. You're essentially forcing Wall Street, to not hedge. Like, there's no hurricane insurance. There's no like actual insurance out on the calendar that would protect you if this thing actually blew up.
Yeah, I mean, that is really hard, right? And if it's a blow up that occurs for a different variety of different reasons, right? Is it a U.S. Treasury blow up? Is
Yep.
it an FX blow up? Is it an equity market blow up, right? Is it the Japanese yen carry trade, or is it the vol dispersion trade, right? Like, we got so many flavors of blow up. It's like Baskin and Robbins, right? But it's, you've got an underlying condition under which we all acknowledge that things are fragile, but largely stable, right? And that's a very interesting and dangerous place to go, right? There's always the expression, never short a dull market. Mm-hmm. The Sharpe ratio of many parts of the market have been absolutely insane, and yet I flip over and look at portions of my portfolios that I run where we have things like short, highly levered equities that are constantly needing to refinance themselves, right? Mm-hmm. Those are 30% below the levels they were pre-COVID, mm-hmm. right? And the number of bankruptcies are going off the charts, right? And meanwhile, everyone is explaining the behavior of the NASDAQ and the S&P. And if you go back 2 days ago, what people were calling you and telling you is just that, well, the NASDAQ was going to sell off because, those companies have a very profitable current franchise business model, and you really want to put money to work in places where, the value is going to be realized further out in the discounting curve. Like, it's just silly. It really is silly, these discussions. You have no certainty about what the forward cash flows are. You have no certainty what anyone else is doing, right? Part of what Craig is pointing out is what we do have certainty on is what somewhere around $20 to $25 trillion worth of assets are going to be doing based on how the parameters of the machine are set up. Yeah,
the conditional factoring, probability weighting based on if-then models that are based on, it's not like it could be predictive behavior. It's 100% certainty what their rules are and what they buy and sell on. So I'll give it an example, and maybe Craig, if you could put it inside of how you think about it, because I basically ripped off part of what you do to try to coach people through this, right?
Sure. Yeah.
So on the macro show every morning, I'll say, let's just knock it down in terms of the real things that matter to me in the Tier 1 alpha data. And we've already mentioned one, where is short-term calendar ball? That's not a debate, that's where they priced options yesterday. I mean, so we just showed you that. It went from 13 to 25, now it's gonna go back to 16 or 17. I mean, we've seen this play out many, many times. Second thing, what Dave pointed out, which is where's the flip line? Where's gamma? Yeah, where's the throttle? Right? We know where that line is. It's right there. It's on the page. So I write these down every single day, and I can't do my job without those things now because now I can see, right? Third thing, GVT, which you guys just kind of introduced. And I'm like, what the hell is this thing? This thing's awesome. Show the gamma volatility throttle chart. Is that
there
the one?
It is.
Yeah, there you go. I mean, so that one, if it starts moving to the right, then you should expect less pop, and if it starts moving left and out left, you should see a lot of pop in terms of throttle. Is that correct?
That's exactly correct. And the reason we developed this is because there was a lot of confusion just around our basic gamma curve and everything else. And I think for a lot of people, they get so fixated on the strikes and where the notional is and everything else. And if you are on that shorter term window, I think that's a fair way to look at it. Mm-hmm. But ultimately, again, why we care about the options market is the effect on volatility. So the reason we developed that GVT model is to make it much more approachable. Instead of looking at expirations, looking at notional, looking at different strikes and everything else, there's just one number that you can track now.
Yep.
And the way to read that chart is the more positive our gamma throttle is, the more volatility compression we expect to see in the markets, and the more negative it is, the more volatility expansion we expect to see. And at the end of the day, not all, like David said, not all gamma levels are the same. And our GVT index does a really good job at actually showing you that convex curve in relationship with volatility, depending on how negative that number is.
Yeah, it's amazing if you do actually wrap the fundamentals around this whole thing, you can really see. I mean, it's not like the GVT moves way left on nothing. Right? I mean, when we went from into quad 4 starting in July, the entire picture started to change. But that's because the economic data is setting up to slow, and as it continued to slow, and the Fed was not really quite sure about how slow, and then the street had to recalibrate what rate expectations were, where the dollar is, et cetera. We can get into that because I think there's a lot to talk about, in terms of carry trades, currency trades, fully loaded. But what happens if you don't have a recession is you should reverse it, and that's exactly what happened coming out of Q4 of 2018. A quad 4 hit. S&P that time went down 20% because Powell was a rookie and didn't do what he did yesterday. This time he's like, no rookie, I'm going to cut. Like he was very proud of his cut. He's
got the nice tie on.
Very positive about the cut. The economy's great. I'm cutting because I'm confident. The things that he was saying. I don't want to get into that, but it's just if you don't have a recession and the Fed is easing, then you should go back to quad 3, and quad 3 is buy anything you can. So to me, like today doesn't surprise me at all because I just knocked it down. I got the fourth thing that I'd look at, we already looked at, which is 1 month versus 3 month. Because that almost mathematical certainty that that's going to continue post a day like today, correct?
Right. Yeah, I certainly think so anyway. When we look at the 3 month in particular, it would take a lot to put that in either direction.
Yep.
So the only way that model would shift going forward is if we do see more volatility into the system, we could see that shorter term vol break back above, and that would change things. And I think the key point there is that a day like today is a perfect example. Is upside volatility is still volatility.
Yes.
And I think that's a very key point because when we talk about some of our other models, like our regime model, we're still technically in risk off. And risk off doesn't mean don't be invested necessarily. It doesn't mean stop trading or short the market or anything like that. But what it does mean is we're in a very unstable environment. And sometimes that instability can be to the upside, sometimes it could be to the downside. But ultimately, it's not that low vol VIX at 12 environment that we saw early July. We are in a different regime right now.
Yep.
Volatility
Well, that fits the quads too. Like the regime of VIX 9 to 14 is everyone's a brilliant investor. Great stock pickers,
Exactly.
we're going to do conferences. That's quad 1 or quad 2. Quad 4 is a shit show. You get big volatility spikes and breakouts that are not episodic and non-trending, they trend. And then when you flip back into the next quad 3 is actually a higher volatility environment, certainly more so than quads 1 or 2. So, because of course the economy is slowing, that's the point in quad 3. So when I think I have a lot of our institutional clients hear me on that, but I know that they know my quad speak, because I've been talking about it for 15 years at this point. But I also know that they still don't know how to see the trend from some do. But when I have these discussions, the fact of the matter is a lot of PMs don't even trade options, right? Like, so they're kind of like, even the language itself can be, a little mesmerizing.
Sure.
But can you show us, like, in some of the slides that you have, that how you see? I said what I see in the very short term with your models, like how you can see in that intermediate to longer term, window.
Yeah, so I think this comes back to this more common misconceptions about it, is you don't have to be an options expert to take advantage of market structure. And in fact, like for me and my personal investing, I've never been a day trader. I've never been on that short-term side of things. I've always been about longer-term asset allocation. And within that very strategic allocation, another word could be tactical allocation, depending on how you define those things. But essentially, I've always been more concentrated is how do I shift my portfolio to navigate these different regimes? And that's really what we've been focused on with a lot of the newer products that we've come out with, is you don't have to be an expert in market structure, you don't have to be an expert in options to take advantage of this stuff. Ultimately, these flows are impacting the market in a very significant way, but there's a less active way to still be able to take advantage of it. And risk on, it's okay to add a little bit more leverage potentially, or lean into those higher beta stocks. In a risk neutral regime, we don't really have such a strong bias either way. And then in a risk off regime, we think it's better to lean towards more defensible positioning while still being invested the entire time. Mm-hmm. Like that's kind of the key point here is, we're not telling you to get out of the market or short the market or anything else. It's just, here is a separate allocation that's more favorable for these more, these risk off, unstable environments.
Mm-hmm. Do we have one of the charts that shows the extended periods in risk on, risk off, et cetera, effectively the vol regime?
Yeah,
there we go.
I love this chart.
Right. So this
Because
is
it's color coded, I can understand.
exactly. Except it's for those who are red-green colorblind, it might be a problem. But
People ruin with the Fibonacci crew and all them. They just mess it up.
Yeah.
Like it's just too much stuff.
Can we actually bring that back
Color,
up? Because I do want to focus on this for a second. So one of the things that Craig is highlighting is effectively that the regimes have persistence to them.
Yes.
Right. And so the vast majority of the time, you're not really going to be changing anything based on this underlying condition, right? You're just going to say, look, things are in a condition under which I am willing to take risk, right? Very similar to your quad type frameworks. But there are also periods, and this is really important for people to recognize it, like when you move into a caution or when you move into a risk off, like some of the most violent rallies actually happen during those time periods. Again, that volatility is volatility. And I think Craig said something really interesting in response to your point on the 3-month versus 1 month, right? Remember what happened in the last 3 months, right? We had the dispersion trade blow up. We had the Japanese yen trade blow up, et cetera, right?
NVIDIA blow up.
NVIDIA blew
Twice.
up twice, right? Wasn't even aware of the second one. But no,
It just was just blown up.
it just happened. No, but the entire point that I would actually emphasize about that is to replace that volatility is going to actually require something pretty severe. And so if it does start to turn back up, then you have conditions that look a lot more bearish than they are right now. But the key point that you made is, you've gone into quad 3 in which you need to buy stuff. That very well may actually be the right interpretation of this. I would just say exactly as you would say in quad 3, be cautious. You don't own that in the same way that you do in Q1 and Q2.
Yeah,
so our stuff is saying the same stuff.
And the Fed will be the last to acknowledge this. Bernanke was the worst, but he devalued the dollar to a 40-year low in 2011. That's the last time gold looked like this, like pervasive all-time highs. And that's the entire world gets the message. The dollar's going down, and things you can buy in dollars go up. EM vertical, gold vertical. So that's not a sign that the economy is improving. It's actually a confirmation that the economy is still slowing, or they wouldn't have the ability to cut. So I think it's great to watch. That chart in particular is that gives the longer term person a pretty damn good idea. You just take your portfolio, if you run money or run your own, and just overlay it against the green versus the red periods. And there can be episodic and non-trending periods in there, but there can be trending periods in there that are just 3 months that you can get taken out back and beat like with the silly stick.
And the one thing I'd add, Keith, is a lot of times, even in quad 4s, we can see upside move in markets, and you'll say, well, that doesn't mean that growth and inflation didn't slow. They did materially, but it didn't necessarily affect the volatility or the flows in the market for that particular period of time. So the data can deteriorate, but the flows don't necessarily, because maybe it doesn't affect the employment market like we'd think. So there's a lot more stability in the 401k flows, and we don't get a vol event. That doesn't mean the data didn't deteriorate materially against the vol markets. Two fundamentally different things. So I just wanted to point that out.
And just the definition of it. What I found yesterday was to me it was almost mind-boggling. Was it only 35% of the flow was 0 days to expiration on the SPYs? That's the average is what, north of 50%? And inside it, there's all this manipulation of NVIDIA and Apple options. You can see it again today. They're buying the crap out of the 120 calls that expire tomorrow for NVIDIA. And what do you guys think about that? Some people get really triggered when I say they know what they're doing when they're doing that. Some guy comes in and he buys 18,000 NVIDIA calls that expire tomorrow. It's not like some dude at the 7-Eleven. These are massive trades. And they impact the flow, almost perpetuate the conditions that you just said, right? If I go to Goldman and say, hey, look, buy me 18,000 NVIDIA calls that expire tomorrow, they're short the calls. They got to buy the stock and or calls, right? So it goes up even faster.
That's right.
What do you guys think about that? I'm getting tons of feedback from institutions on that. They're like, well, who's they? I'm like, Chicago, Boston. What do you think?
So 0DT has been a massive shift in the market, but I think it's changed the market structure in ways that aren't as obvious as just people are buying a ton of out-of-the-money calls for the next day or anything like that. So when we talk about 0DT for the S&P 500, for instance, I think a key thing to remember is that a lot of the hedging that's happening is actually happening with other 0DT options.
Yes.
It's not necessarily happening with the underlying. And when you don't have that direct link to the stock or the futures or anything else. You have to look at it in a different way. So the way that we look at 0DT and how it's really changed things is that it's actually allowed people to have these shorter term trades. Going into the Fed was a great example. We saw that short dated vol curve spike up, and what a lot of that is people hedging ahead of the event.
Yep.
So before 0DT, pre-2022, people were buying 30-day options, 3-month options.
Yep.
They were going way further out on the calendar. But now 0DT has allowed people to just play those trades in a shorter term. And what that's done, this could actually go back to August 5th and this huge spike that we saw in the VIX. What that's actually done is take a lot of volume away from hedging those longer term options. And that's why we think the VIX has been so rusty over the past, call it 2 years. And then on August 5th in particular, as Mike noted, there's a huge lack of supply for 0DT, right? Market makers just weren't offering, the bid-ask spreads on them were just huge. They just weren't offering those options. And then we got to see all of that volume, all of that hedging activity get pushed back into those longer dated contracts. And we saw a massive explosion in the VIX to spot beta. I mean, it was just absolutely insane. But we think most of that, we could talk about the yen carry trade, the dispersion trade, everything else, but specifically with the VIX, we think that massive spike was really drawn by those longer term options being re-engaged because the 0DT options just weren't available that day.
I mean, literally, just think about it, right? If you got into the car with your wife and the GPS didn't work and you needed to get somewhere, right, that you hadn't been before, what would you do? Right? I mean, seriously, like, how do you handle this incredibly? Well, I'd pull out my phone. Well, the phone isn't working either.
Yeah.
Right now, you're really so what do you start doing? Well, you dig into the glove box. You're like, we got to have a map in here somewhere, right? And that's effectively what happened on August 5th. Was people like, okay, get me some. They're not trading, right? Why are they not trading? Because the volatility is too high, the bid ask is too wide. So, all right, well, get me some protection. Buy back my positions. And those who really had to do the trades were those who had actually shorted index vol at the 30-day point, had bought against that the individual stock positions. That's what the dispersion trade is, right? The individual stock options. And when they had to buy back those index options, I think we shared this in the Tier 1 note on that day, you saw implied correlation go to 240% on some of these options. Right now, like theoretically, 100% correlation is the most you can get to, but remember that these are two separately derived prices, right? So they don't actually have an arbitrage between them, as people like to imagine. And all that was telling you is that index vol was just massively bid over the single stock options, which were being sold for the most part because people were unwinding their positions, right? So you just had this crazy experience that highlights how important and fragile even a robust system is, right? It's super robust. How do we get to the restaurant time? Well, I'll just plug it into the GPS or into my phone. We've got multiple choices, right? Well, when those choices disappear, you and your wife fight more. The drive to the restaurant becomes more tense. You got to take extra time to do it. All these.
You're reminding me of real life stuff.
I know. But that's actually part of the reason why I emphasize this, because we take it for granted that once we accept the financial innovation and move beyond the initial, well, that's absolutely crazy. What idiot would buy a 30-year adjustable rate mortgage, right? Once you move beyond that point and it becomes a standard part of your life, when it goes away is actually when the big events occur, right? That's really what 2007 was all about. When you think about the housing crisis and the global financial crisis, right? It was that ability to continually refinance my adjustable rate mortgage at a lower rate, right? Find the next sucker who was going to do that, who was inevitably a West German bank, right? Landesbank from Germany, right? So those sorts of things, when they go away, that's where the issue becomes. And the things that we keep highlighting are the rigidity that are created around this market structure.
Yeah, I mean, when NVIDIA's 1 and 3 month price momentum goes away, all that happened on that. For those of you that don't remember that day, the VIX went to 60, 65 at one point. But NVIDIA is 7% of the underlying, and the stock had gone down 30% from where Quad 4 started hitting. And everyone's, the NVIDIA calls, that if you watch that on the most actively traded options board, it's generally been SPYs, right, or Qs. Now it's NVIDIA right up to the top, right? I mean, so it's like that game within the game is really interesting to watch. There are institutional players obviously perpetuating it with a very good plan and a profitable one. There's a reason why some people have many more nice houses than others, and then they know that the predictable, kind of talk about real degenerate behavior. You're an individual, rocking it out in your basement, buying YOLO call options in NVIDIA. So they know that that's going to happen as well. I just can't get that kind of off the screen every day. When you have such a centerpiece to the whole piece, with such impact.
Sure.
So I find that your impact table is super helpful, where we show, as you can show, yesterday NVIDIA was actually negative, right? Because when you're kind of worried or you're hedged and you're buying puts and you're like, ooh, NVIDIA's like, it was like negative 14% impact on S&P versus Apple. It was one of the few days where those go opposite each other.
Yeah, it was actually
exactly why you got the performance you got yesterday.
Yes,
right?
yeah, exactly.
It's yesterday was a really interesting day from a breadth standpoint because there just was so little trading activity. So we talked about this in 0DT, but we also saw it in market breadth, right? Stocks just weren't moving, and I think that's just because there's so much debate over whether it's going to be 25 or 50, and then it was 50, and then people didn't know what to do with it. So, today is when we're seeing that reaction, because I think yesterday people were just too scared to trade. They just didn't know what was going to happen, and or how the markets reacted. And so what did we get? We got a completely flat day. We saw 0DT volume crashing. We saw market breadth basically at a standstill. It was really interesting to see.
Yeah, I kept saying I'm taking my gross down, taking all my, because there were so many winners going into that. I mean, if you're long basically bonds, gold, bonds, gold, bond proxies, utilities, REITs, they'd all gone roof into the rate cut. Rate cut meaning that down bond yields, that's why you buy those things. So today is much more about a dollar and a rates move. I mean, you get the follow through of that dollar move. Let's get into that too within the lens of the carry trade, because it annoys me beyond being annoyed, and I can be annoyed if I just spend like 10 seconds on Twitter. The whole, well, it was just the yen carry trade, like nothing else.
Yeah.
Like August 5th in the U.S. stock market and or the initial pricing in of multiple rate cuts didn't impact the dollar.
Right.
Yeah.
And I mean, just a quick history lesson, and we were joking about it earlier that everybody's a carry trade expert now, west of the Ganges, everybody. And the carry trade sort of first sort of got its fame in the Westpac agreement between the Swiss was actually in the early 80s. So the Swiss franc was actually the predominant carry vehicle at the time. And if you were and they were typically engaged with Australia and New Zealand. So they were trying to develop Western Australian the cotton industry and the beef industry. And so the Swiss National Bank at the time had their rates set at 5%. The Aussies and Kiwis were somewhere between 15 and 20 at the time. Seems inconceivable now, obviously. But the banks were offering this carry vehicle where you could literally walk into your bank, called the Westpac Agreement, and say, I'd like to buy 3,000 acres in New South Wales, and your banker said, great, that'll be a 15% mortgage, sir, or we can lend you this packaged carry trade called this Westpac, where basically they would lend you Swiss francs at 5%, and you could go off and start your farm and go fishing on the Gold Coast on the weekend and buy yourself some cattle during the week. And so this was fine for about 2 or 3 years.
Great. Sounds like a great life.
And and the exchange rate, well, what happened is that these farmers essentially didn't really understand what they're getting themselves into. So every month they would come by and they would swap their Aussie dollars for francs and they would pay off their loan for that month, and everything was great. The currency fluctuation was sort of 2-3%. And it went on fine for 4 or 5 years until 1987, when we had a massive vol shock, and it had nothing to do with the Swiss National Bank, it had nothing to do with the Australian fundamentals, that had everything to do with the vol shock going into 1987. Well, the Swiss franc gained 25% essentially in a couple of weeks. So farmers that had loaned $1 million now owed $1.4 million in Australian terms. So literally overnight, their loans went up 40%. And every carry trade subsequently has blown up on really what is a vol shock to include this latest carry trade. And leading up to it, it's not coincidental that all through summer we were highlighting the dispersion trade, the massive adoption of call overriding strategies and the vol dampening effect of that. And the Bank of Japan, they were intervening every so often, and for you and I, it was basically a yen selling opportunity.
Yeah.
And so nothing had really changed fundamentally, and including this time, but now we've had a vol shock which undid their carry trade. But it's interesting because, you know, the Japanese are massive importers of predominantly energy, and that was what was driving the inflation. It was import-driven inflation. It wasn't necessarily domestic spending, that domestic consumption that's driving it. Well, now we've had a ton of yen strength, and so are we going to see now a Japanese deflation event while they're trying to raise rates? Unlikely, I would think. So anyway, the point to this is simply following the flows is a great mechanism for being able to follow what is happening in the carry trade.
Yes.
And it wasn't coincidental that the carry trade blew up when our systematic index was also at its peak exposure.
Yep.
So it was sort of this perfect storm of structure changing. Oh, and by the way, a big mechanism for the leverage that's been happening is this yen carry trade.
Yeah, they don't come out of nowhere, right?
No.
They come out of nowhere for the macro tourist. And like you
Correct.
say, all these experts that are born after the event on any topic, really, in
Yes.
macro, they at first happen gradually, then they happen all at once. Like we show it, guys show cross asset class vol, show the global currency vol chart. Okay, now most people who trade stocks don't even know what that is. I mean, but it's like it's only the biggest thing to get right if you're going to get currency vol right is to look at currency vol. I mean, so you know the yen goes to a 38-year low. Vol goes right down into the soup. People are like, okay, this is great. Dollar up, you know, yen down. This is easy. We have like CFTC non-commercial net short position, like 1 million net short contracts yens. Yeah, all these things just become, and we show that every week on that data. But I mean, they become a consensus, and the consensus becomes the risk if the conditional factoring changes, right?
Right.
And the only way you can see that is if you look at your data and my data every morning together, I think.
It's not just what happens, it's when it happens. And I think that's the key point about it all. Is the market in a vulnerable spot for it? Because there's plenty of times when we get bad news or something bad happens in the economy, markets just don't care. But when markets are in that vulnerable spot, that's when you see these little moves turn into bigger moves. And that's honestly what we're all just trying to capture, right?
Yeah, I in my heart of hearts, which is like a big heart for this, I hope that the future state of our industry, people when they wake up in the morning, these are the things they look at. Like they don't just look at Spy Monkey. I mean, that's embarrassing.
Well, I think it's difficult to hold yourself out as a responsible fiduciary to the man that owns, you know, a tire store and say that I'm your fiduciary, I know everything about markets, I'm guiding you, and then you don't have transparency on 50% of the investable assets. I'm not sure that's professional.
Honestly, I think it's a good point, and you know, I just want to clarify too. Like, we're not saying don't pay attention to the fundamentals or don't pay attention to the macro. Like, that's ridiculous, right? But what we are saying if that's only what you're paying attention to, you are missing about 50% of the market and how they're making trading decisions. And that's what we're just trying to bring light to, is what's happening on the computer-driven side of the market, kind of behind the scenes that doesn't get nearly enough attention.
What are like some of the other top kind of questions you guys get about your product, or like confusion, misconceptions?
So the big one is honestly, I think, duration, because like I said, everybody wants to day trade this stuff. The second biggest misconception that we get is people think that they need to be quants, so they have to have coding skills to be able to use these strategies.
No.
Absolutely not, right?
Yeah.
And there's a little bit of truth in that. If you want to build this stuff from scratch, you have to be a quant. You have to be a developer, right? But we've done that hard work for everybody. So they could just come to our product, and you could still, you don't have to be in that realm to really take advantage of it. And then, the last thing that I think a lot of people get wrong too is on how to express the trades. And, they think it's an option trade or something else. And the thing that we really want to stress with people is if you are managing any sort of capital in a portfolio, these regimes really matter. And they have to matter because, when it's a discretionary manager and an idea on that, like, it's a little bit difficult for us anyway, which is why we focus on this side of the market, to understand why people are always making those decisions. Somebody buying Apple because they think iPhone sales are going to go up or it's going to be some great thing with their earnings, or somebody buying Apple just because their friend told them down the street, and then suddenly they're like, oh, okay, yeah, it works, we'll do it too. But with the mechanical flows, as you mentioned earlier, like, these just follow rules. So there is an inherent predictability as long as you can understand the strategies, and ultimately, that's what we're trying to bring attention to. So lots of moving parts, We understand that. I guess this would be the last thing. And we already showed our regime model earlier, and that's really why we developed that. Is if you're going to look at one thing every day, we would recommend looking at the regime model. If you want to look at what's driving those regime shifts, that's when the rest of our note really comes into play.
Well, I think, having struggled for 25 years to get better at this damn game, people, the smarter they are, the more they're going to read, and the more they might get confused. So.
I think that's fair. Yeah.
I think that's very fair. I also
especially in your world.
I think that's very fair, but I also think that if you're learning, you're always pushing yourself to that edge.
Yes.
Right? And so bring yourself out to it, ask questions, go backwards 2 steps, and then move forward 3, right? And you'll be fine. But at the end of the day, all of this stuff is, as these guys are saying, we're really just trying to understand that portion of the market that is increasingly systematic, that is increasingly driven by the high frequency components of the market and their need to actually meet regulatory requirements. We're going to see this play out. We're going to see this play out across the industry. As we look at things like zero day to expiry options, there's regulatory changes that are coming around the clearing of zero day to expiry, the margins that are required around it. This is going to be a significant change, and one of the best places to stay apprised of that is actually going to be what we're writing on it.
Yeah, what you write on every day. Craig could tell you, like any private email I've sent him, like some of the questions are like beyond basic. I'm sure you're like, really? He doesn't know that? But maybe you didn't react that way. But I have no problem asking a basic question. Like if I can't figure out what to do with it, then I'm not going to use it.
The smartest people in my experience are the people who are least afraid of asking the dumb questions.
Yeah.
Right.
Well, thank you. But like for example, like GVT. It's the most, at least one of the more, the GVT chart we've already shown. I immediately sent you an email. I'm like, can you explain this to me? Like what?
Right.
And he's like, if it goes to the right, it's less. If it goes to the left, it's worse. Like, okay. Now I know what I'm looking at. Like you don't actually, the goal for anyone running real money and or their own, which is real money, I think should be able to take your tools and quickly summarize it by looking at it. You don't have to spend like an hour on it. Just, okay, this is what changed today. Oh, nothing changed today. 2 things changed today. Because what you notice, it's again Mandelbrot 101, it's the particular things that start to change at the same time.
Right.
Exactly. Copper broke out today. This is on the heels of silver breaking out. So we're getting, again, this would be a sign of not quad 4 disinflation, but reflation of asset prices in the commodity space, which was the biggest loser essentially during quad 4 disinflation. But you wouldn't know that if you didn't look at the risk range sheet that we put out every day, that when it said bearish trend for copper for the last 3 months, and today it says bullish. Right. Yeah. So same thing with you guys are very good at calling out those particulars, and I think in order to save time, maybe that's for some people that would be part of a solution, but I don't think you can get there unless you do what Mike said, which is you gotta try to learn it, right?
You have to try to learn it, but I would say that you don't have to be an expert in it.
Right.
Because you can still take advantage of it just with kind of a basic understanding. Like once you accept, again, I really want to stress this point, which is why I'm repeating it. Once you accept that 50% of the market's operating on these rules, you're almost forced into at least acknowledging that you need to start paying attention to it. And our goal with, as our current subscribers know, we're relaunching our product. We're coming out with a new report that's much more intuitive. It's got some educational components already built into it to make it much more approachable and actually actionable. And I think that's another thing with market structure. When you hear a lot of other sell-side research shops, big banks talking about this stuff, there's a lot of jargon, which is unfortunate. It's what the industry has developed around these concepts. So we have to use them too, unfortunately. But ultimately, it's a lot of theory, and we're taking that theory, and what we've been doing forever is putting it into an actual usable model.
So. I stay with that. Like in as much as we have to keep learning it, you have to keep coaching it.
Oh yeah,
like
absolutely.
There's one thing I've learned in the last year, like from July of last year when I was getting my ass handed to me in the market, and it was like one of the worst months in over 20 years. And I'm like, something's got to change here. Like I'm missing something. The process has to evolve. So tweak certain models, change certain components of the process to get more accurate. But really what it forced me to do was coach it better. Because if you're going to use something, you better understand it. Right. Now, I don't need to know how a chainsaw was built. There is a McCullough brand chainsaw, nice chainsaws. But I can use it. I know how to use that. I need to do some safety checks and.
It's one of those things you want to read the manual.
Yes, you want to read the manual. You want to understand how it works. But I don't have to have invented the chainsaw to use the chainsaw.
That's exactly.
One of the little nuanced things with the regime model is it'll never go from risk on to risk neutral to risk off. It'll go from risk on to risk off. So that'll be an immediate change for people to notice. Now, building back up, we can go from risk off to risk neutral back to risk off. That's conceivably happening. That can happen, but you'll never have a graduation down when you're going risk on to risk off. So when people are reading the report, that's a particular that they should pay attention to. In how they think about hedging tails, etc. If we go risk off, you should now start digging into the component parts of the report and actually see what's going on.
One thing I always say about this is the same with any of your signals, like mine. I think the parlance is when the prior stops working. Like so, when my quad 4 portfolio stops working, that means the quad is shifting. Right. When your regime's shifting, that means it's shifting. Don't stay in the prior. Like it's you actually. I always say, as soon as I start losing some money, I know I need to move. And that's not like in a twitchy way. Like a quad shift is like we just had 3 months of fantastic quad 4 returns across asset classes. So it's not like a couple days is going to change my life. I mean, it's going to change my position. And some people are very uncomfortable with that.
Well, one wants to get academic about it, right? I mean, something's been working, you fall in love with it, or you shouldn't. But it's time to get on Bumble and find another one. And obviously, I'm being callous about that. But being less academic about those changes is often a good thing.
What's cool though about the academic side is that like you're probably number 1, 2, or 3 in the world, like in academically explaining what's going on.
Explaining definitely, not in terms of understanding or practicing, but
but like we have both, right? Like I'm basically the mucker trying to summarize all this stuff, and there's a reason why I had the lowest SAT score at Yale. Like my advantage is that I'm not that smart. I can just get to the point, right? That's a huge advantage, I believe. But there are people with much bigger brains like you that can really. First of all, this wouldn't exist if you guys didn't come up with it, and I would be completely blind.
Well, to be fair, actually, I mean, people have been talking about this on Wall Street for a while. It's just as buried as our stuff sometimes feels in jargon. This is a distinct attempt to dumb it down, put it in a position that is accessible and understandable to a lot of people.
Yes,
right.
Like accessible is the key term in there because a lot of this stuff is not talked about a lot. And considering it takes up such a big part of the market, you would think that it would get as much attention as an economist talking about the economy or anything else, but it just doesn't because people know what they're looking at, and I think they don't want to share that they understand how these flows are working and how it's affecting the market. So that's what we really want to do. We're really passionate about spreading the message on just how important this stuff is.
Buy-siders that I've spoken to, institutional buy-siders who only trade options, are like, this is the real deal. Like this is. That's cool. And they're also tired of the blather, right? Because even in the institutional community, these daily notes that come out of Goldman, some of these notes are just like, wah, wah, wah. It's just like rear view looking spew. And you guys, it's the opposite. It's right to the point.
Well, I will tell you that's how I got involved, candidly, was I started looking at the stuff that Craig and David had started working on and said this is very consistent with the way that I approach the world and the way that I think about things. I would want to be reading this before I make my morning notes anyway.
Good.
Right? And so the writing process for me in the morning, like I'll probably continue doing elements of it. I read the note first, I make sure I go through the process, and I think about how am I digesting. This is really kind of the first section of the writing that you see. That has historically been me kind of digesting how I would interpret what I've read in the note below and how I tie that to the rest of the data that I'm seeing. Sometimes you'll see me bring in a macro concept, sometimes you'll see something totally different. That would happen anyway, and it was really an attempt to get better information and better tools for us individually that then made its way out. Part of the transition that we're at right now is candidly the tools that we're developing are actually now standing increasingly on their own with less explanatory power, and that gives us the flexibility to go start to build other stuff, right? Like the risk signaling stuff, candidly, we're going to start using it professionally. So it's, it's being used in portfolios. It's extraordinary the impact that it has, particularly on the risk control. And I do think that that's one of the things that people also need to then be thoughtful about, which is, as you're in that quad 3, as you're in that quad 4, as the world looks a little bit less simple than simply the recovery out of the coronavirus, risk control is going to become really important.
Yep.
You hear a lot of people spending a lot of time talking about lower expected returns for equities. Very few people see positive expected returns, real expected returns for bonds. I happen to disagree with that, but that's a totally separate conversation. Commodities, same thing, right?
Yep.
What does the world look like in which China is not really growing? Right? What's the demand for commodities in that environment? The IEA just came out with a forecast that says oil demand is going to peak in 2030 now. Right? So this is a world we've never inhabited before. And I honestly think that risk control is going to be one of the most important things to think about as you go forward.
Yep, and having the tools to look right at it every single day. So, any other topics that you guys that were top of mind that you think?
Yeah, I think it might be interesting if Eric could bring up some of the data on the risk regimes towards the end of the deck.
Okay.
And it shows two things. First off, okay, so this is our risk on regime, and this is the data that we've collected over it, going back for about 25 years. And if you look at the length of some of the risk on regimes, this is exactly what we're talking about when we say, there's longer term implications to the market structure. It's not just day trading. There's actually longer term trends that you're able to capture with it. And we're one of the only shops that are really focused on that longer term aspect that have been able to capture these trends. So, risk neutral, you kind of get a little bit of both. That's why we were saying we don't have necessarily a strong sense either way. And when the model shifts to risk neutral, we do think it's appropriate to add a little bit more exposure to equities because it can be a transition stage. But also, we're not super confident that we're not going to switch back to that risk off regime. And then finally, the risk off regime. And what's really important here to understand is, from when the model shifts to risk off to that risk neutral isn't always where the max move is. So if you look at the max drawdown under these regimes, that's where the real meat is on this stuff. So if you're looking to add a little bit more tail hedge to your portfolio, these are the moves that you're able to capture with it. And let's say you're a day trader and you still want to use this kind of stuff. We also offer some allocations that go along really well with these regimes. It just kind of shows you that, if you're going to take a trade, maybe just make it a little bit smaller than you normally would under a risk on regime.
Yeah, that's perfect. I mean, that fits with what at least I'd expect it to look like. You go from, you go on these long runs of the bullish regime, then you go to neutral for a very short period of time relative to the other two regimes.
Exactly.
Because you're in a phase transition, and that's what it's telling you, and you don't have that many days. Like I always say, I don't know when the quad shift's going to happen, but when it's happening, I'm going to know, right? So then you get into these vol spikes that are born out of the prior regime shifting, and there are less days. I mean, and then the Fed comes in.
And then the Fed comes in. I like that. Yeah, exactly.
Well, I mean, it's not a fake news thing, right? I mean, the Fed policy is, they'll talk all day long about price stability and full employment, but it's what's the S&P 500 doing? I mean, that's definitely the third part of the three-legged stool.
It definitely feels like that. I'm certain that the history books will go back and say, on August 5th, volatility erupted across U.S. equity markets, and the Japanese yen carry trade on one, and therefore Jerome Powell. Yeah. Right? I mean, that's going to be what the history book says.
Yeah, I mean, it's a fascinating thing to watch. Do you guys find, when you look at, well, first of all, who would you follow that isn't us? Because we're in an echo chamber here, right? We're content partners. I use your product exclusively. I don't use anyone else's options. I don't, I use it for entertainment value if I read the GSPB report sometimes, just because it will sometimes say the opposite of what these guys are saying.
Yeah.
And it's is there, if you don't mind, is there some, I think Charlie's out there at, I don't know where, he's at Nomura. I think you have some
Chris
respect for his work?
No. So I mean, look, all these guys are very good and very smart, right? And so there's two separate things that you're dealing with. One is if you want to get Charlie's work at Nomura, it's going to cost you hundreds of thousands of dollars in guaranteed minimum commissions.
It's just an institutional product.
It's just an institutional product. Chris Metley at Morgan Stanley, John Marshall at Goldman Sachs. These are all guys that are very much part of what I would call the market structure mafia. Rocky Fishman, who's over at MRA, an affiliate of MRA now, launched his own shop, ex-Goldman Sachs guy, right? So all these guys came out of the options world and basically recognized that in a frictional environment, right? So if you don't live in this magical EMH world in which there is basically zero friction as people transact, and yet somehow or another they're supposed to have an incentive to put their ideas forward and have everything work. If you exit that world and you recognize that there are players that are forced to hedge, that are forced to go home basically flat every single day, that are not allowed to take significant risk in a directional position, and yet are responsible for managing books that have billions to trillions of dollars inside them, right? The minute you recognize that that friction occurs, insights start changing and your analysis starts shifting, right? An earnings report becomes a mechanism that is going to shake it loose and force somebody to transact. Right? And so if you think about it in those terms, this whole process actually becomes very straightforward. You're simply identifying a growing fraction of the market that either will never transact, i.e. passive, unless it receives an end order from its customer that says, hey, I'm retiring, give me my money back, or guess what, I got a paycheck, here's 6.5% of it, right? 11% if you include employee match. If you think about the next stage of the cycle, it's going to be people who are facing an event, right? And so I have to hedge against this event because this could cause volatility to explode in my portfolio. And on the flip side of that, unlike everybody thinks about the options market as being the same as like Apple, right? Just think about the difference. I go to buy Apple, you go to sell Apple, that's the same Apple. I want to buy December 21st, Apple 123 calls, and you want to buy what exactly, or sell what exactly? Like the odds of you and I being in the market at the same time, transacting that same product, that same tenor, that same strike, are basically zero, except in two places. One is zero data expiry options, which as Craig points out, like the vast majority of the volume is really happening amongst dealers, and so they're constantly trading. You try to show up and want to buy something 50% of the money on the same day, not going to get a bid for that, right? That's not going to happen. But they are constantly trading that. If you go further out, it's a kind of an appointment-only market, and that's what the market makers are doing. They're facilitating through put-call parity the ability to do those transactions, to execute that particular trade, et cetera. And as they become larger and larger and larger as a fraction of the market, like it just becomes more predictable, even as it doesn't become easy. I just want to emphasize that.
I mean, it's one of the few honey holes on the sell side, like Susquehanna's options business, Goldman's option business, Citadel's options business. It's good though that you named some names because what you've done is you've essentially done what we've done. You've democratized the access.
Exactly.
Because I don't the reason why I asked, and when I was making fun of Goldman, it's the Goldman, when I said GSPB, Goldman Sachs Prime Brokerage Report. That's written by people that aren't Charlie at Nomura,
right?
Or some of the well-known Goldman guys that have remained there or left. This is the it feels like the market is doing this today. There's no feel. I mean, that's old wall talk. But if you did have access to Charlie's, you probably would read it. But like you said, it's extremely expensive. That's why
it's extremely expensive, and it is really hard to understand. Right? And so,
it's designed for institutional readers who that's all they do. Right? I mean, and there's a lot of value in that. But there's also a lot of value in simplifying the complex.
Totally agree.
So. Thanks for doing that. I couldn't do my job today if you guys didn't do that. So,
awesome.
We are out of time, but thanks, guys. Appreciate it as always, and I'm sure we'll do it again soon.
Excellent.
That's great. Thanks for having us on.
Tier 1 Alpha. If you don't read it, you're not in the game. So, all right, pay attention to that. If you have any questions, they're really good at answering them, simplifying the complex. That's what we're trying to do. Thanks for joining us.